Hi there, guys. So today we'll be speaking about whether or not you should invest in property in the UK via your personal name or a limited company. Now, this has been a debate or a conversation topic for property investors in the UK for, I'll say, for the last 4 years or so. And in these videos, many of you might be used to my videos where it's a lot of editing, a lot of transitions, but I'm just really going to focus on providing value and getting to the nitty gritty of things there. So in this video, what we're really going to do is explore the main points of let's say pros and cons for purchasing property in your own name, but also purchasing a property in a business or a legal entity for that specific purpose. So again, we're going to deep dive in there. Feel free to subscribe if you're watching this on YouTube, but let's get started. So what is the debate? Why is there a debate? So the debate really came as a result of a transition in the tax in 2021. So historically, many property owners opted for putting properties in their own name because, again, it was very straightforward in the UK, very convenient, and the tax laws, the tax structure in place at the time was really pro this. However, due to the changes in tax legislation, many investors had to start reevaluating this because, again, because of those changes, it really did impact profitability for traditional buy-to-let. So the introduction of, let's say, Section 24 and the alterations to tax allowances really led to a surge in corporate entities. So many individuals who had properties in their personal names really were looking at the limited company setup. And one of the reasons for this is the treatment of mortgage interest. So prior, you could deduct your mortgage interest as an expense. So again, that would increase your profitability. And in the past, property owners really saw this as a benefit. However, due to the recent changes and that phase out of that and that allowance per se, that really impacted the profitability for many buy-to-lets in the UK, particularly for higher tax rate taxpayers. So as a result, the popularity for limited ownership for property investing has been a topic of conversation. So the reason why many people are looking at the limited companies is due to limited liability. So for many of you who are business owners already or have other business interests, you really understand that this company ownership shields your personal assets from business liability, and that's really crucial, especially in this unpredictable time that we're in at the moment. On top of that, as well, is the ability to leverage those tax reliefs. Now, a lot of those tax reliefs have reduced, especially if you are doing Airbnb arbitrage. But that being said, it really does give you some options there. But ultimately, the debate itself extends beyond a simple comparison of tax rates, but also administration. There are costs, legal and accountancy costs associated to this as well. So it really does require every individual finding the right advisors to see their specific unique circumstances to see whether or not this works for them. And on top of that as well, I would say, and I like to add, that it really comes down to your goals. So if you are looking to have a smaller portfolio, you might opt for just doing things in your own name. But if your goal is to have build a larger portfolio, or you have a larger portfolio, again, consider putting your properties under a legal entity. But again, we'll go through all of that in this video. So let me give you a real life example here. So let's just say Sarah is a property investor. Okay. Now and she has a portfolio of rental properties, traditional buy-to-let. So she earns £1,500 per month in rental income for each of her properties. Now, with £800 going towards her mortgage interest. So that makes sense. 1,500 per month, £800 of that going towards her mortgage interest, right? And that results in a monthly profit of £700 per month, or annually £8,400 per month. Okay. So on the personal ownership side of things, in this specific scenario, Sarah owns properties in her own name. Okay, and if they are in her own name, she would fall into the 40% tax bracket. So she would pay £2,800 in tax annually, leaving her with a net profit of £5,000 per property. Okay, and that gives you a breakdown of what that looks like. So if we just go into the calculation of tax, so that's 40% of the profit after that mortgage interest, so that's around £3,000. Now, if you were to take that annual profit and you minus that by the your tax bill there, you're left with a net profit of around £5,000. Now, under the limited ownership scenario, if Sarah was to set up a company to hold her properties per se for this purpose, she can deduct the full £9,600 mortgage interest from the rental income. So that would result in a taxable profit of £0. So therefore, with a corporate tax of 19%, I believe now it's 22%, the company would pay 0% tax. So that would leave the full amount of £8,400 profit to the company. Now, in this example itself, owning properties for a limited company allows you, the investor, to retain a higher net profit compared to personal ownership, even after paying corporation tax and also income tax as well. But again, you do need to take into account there are accountancy fees for managing this entity, and also legal setup costs as well. So it's not just £0. There are associated costs as well. Now, one really important thing to take into account is that change in tax landscape. So the tax landscape itself has gone under several changes, particularly for property owners, real estate investors. In one. So these changes impact the rental income that is taxed and the deductions that are available to you, the investor. So again, the changes in the tax brackets and rental income. So in 2024, tax laws have introduced new brackets and rates for rental income. So for example, if a landlord's income falls into the high tax bracket, then their liability will increase, and that will reduce your rental income. So again, in Sarah's example, you wouldn't be on the 40% tax rate. You would probably be on the 50 or 60% tax rate, and that would reduce your tax income dramatically there. Now, on top of that as well, there's updates to the depreciation rules for rental property. So the rules in 2024 really means that either an increase or decrease in the amount of depreciation that really a landlord can claim, and that of course will impact your rental income. So the change itself can impact the profitability for the rental properties, as depreciation is a tax deduction for rental property owners. So you've got to really take that into account. Now, on top of that as well, the changes in the tax laws for expenses. So what that effectively means is the expenses that you're allowed to deduct from your property have changed as well. And there's changes in capital gains as well, and also new regulations for reporting rental income into for your property as well. So these changes in the tax landscape requires landlords and property owners to be more diligent in the record keeping and to keep up to date with tax payments and really getting the right advisors around you. Not doing that will result in fines as well. So again, taking into consideration what's available to you in relation to expenses and relief, and the ability to offset mortgage payments as well will really are things to consider when deciding to invest via an entity or directly. So pros and cons of owning a property for a limited company are the follows. for a company. There's better taxation of mortgage interest. Now, limited companies can again offset 100% of mortgage interest, and that reduces profits and also, well, that increases profits and the amount of tax and reduces the amount of tax paid as well. Bear with me. On top of that as well, there's flexibility with profit. So you as the company director, you have that flexibility of what you want to do with the profit. So you can invest that into future properties. We and some of our advisors we work with would recommend that you should set up an entity for each individual property that you buy. But again, that's entirely up to you. Pardon me there. Pardon me there. But let's just say, for example, you want to use that one entity to purchase further properties. Again, it's very tax efficient, a much more tax efficient way than purchasing directly. And again, you can reinvest the profits from the properties into purchasing purchasing future properties. Now, on top of that as well, again, it's really good for retaining profits. So retaining earnings within the company will help you to protect from tax liabilities and also allows you to really expand your property portfolio further as well. Now, I think, again, this is my personal opinion, one of the things that are really, really beneficial for setting up a entity to purchase a property is really inheritance tax planning. So the property held within a company gives more options when handing down a property to your loved ones, right? And really planning for inheritance tax. So it makes it easier to transfer the business to future generations rather than it be in your own name. On top of that as well, there's that limited liability, which provides liability for you as the owner of the property rather than having personal liability. You have that entity to protect you. And on top of that as well, there are potential tax savings as well because your property held within the limited company is not only will reduce your inheritance tax bill, but also your subject to corporation tax rather than capital gains tax as well. Now, the cons for this, because there are cons for this, is there are higher costs and complexities of issues when setting up a entity for property investing. So, with limited companies, again, you need an accountant, a good accountant that understands property investing, and also your accountant can set up the company, but also a good legal advisor as well. Because filing accounts for company house and HMRCs really requires a professional. I've seen many investors file their accounts late or in the wrong way and have to pay fines as well, which then massively reduces your profitability there. Now, there's a loss of some tax reliefs as well. So companies do not pay corporation tax on their profit like an individual would, but there's where they do not qualify for principal private residence relief on future disposal. So again, speak to your pardon me, your tax advisor, your accountant regarding this. Now, it's also less favorable for mortgage options. So there are mortgage providers have become better at providing mortgages for limited companies, but again, there are a much smaller pool of mortgage providers that will provide you a mortgage. But I believe this has improved. But again, speak to your mortgage advisor before even setting up, just to see what options are available to you. On top of that as well, there's the stamp duty surcharge. So limited companies pay an additional 3% on top of the standard stamp duty land tax on all properties purchased, including the first one. So again, take that into account. And of course, personal tax changes. So removing large amounts of profit from a company as a dividend will incur tax charges of up to 38.1%. So again, something to take into account. So, in summary, owning a property portfolio for a limited company has its advantages. Better taxation, also offsetting mortgage interest, flexibility with profits as well. However, there are disadvantages such as higher costs. You really do need advisors for this as well. Less tax relief. So, again, essentially, you need to see which pros outweighs the cons and what works for you for your goals as well. So, consideration for decision making, I would say the factors that you need to take into account is your income. So, where are you at the moment? Not so much your age, but your investment goals will really play a huge role into this. So, as I said throughout this video, really what it comes down to is, are you looking to build a large portfolio, which will then push you into the higher tax bracket, sorry. And if that's the case, you really should look at a limited company, and that might be a more suitable option for you. However, if you're looking just to replace your income from your job, you can just do it under personal ownership, less costs, less paperwork, and that's something you can do with your bookkeeper and, of course, accountant on your year-end submissions as well to HMRC. So one thing I would always say is, before doing any of this, you really need to seek advice. So whether you're looking to own a property in your personal name or company name, really you do need to have a tax advisor or accountant on call who really specializes in property investments. They must specialize in property investments, because again, it's very different setting up an entity for trading purposes and an entity for an SPV, a special purpose vehicle for setting up your property. Now, what these professionals can do, and I don't really need to go into it, is really personalized advice for your specific goal. So again, tax advisors can really help in understanding what is it you're looking to do, and also the potential tax changes and mortgage interest deductions that your portfolio will be subject to currently, and also future changes as well. So these professionals could really assist with those ongoing compliance and reporting to HMRC, or just making sure you're tax compliant as well. So one thing that I've seen just with some clients that have come to me, that I've advised on, is they tried to do things themselves, and what they saw was a massive tax, not only tax bill, but also penalties as well, for doing things the wrong way. So really, in summary, just seek professional advice from tax advisors, accountants, maybe a property lawyer as well, to see which ownership structure works best for you. So in conclusion, what are my thoughts on this? What I would say is, again, it's an ongoing debate. And I think the reason why it's still an ongoing debate is because it's not one size fits all. It really comes down to your circumstance. I would say, if you are a investor who is really looking to grow a portfolio, whether it's over a time, but a large portfolio over time, whether it's slow or quite aggressive through raising funds, you really do need to look at that company structure, that SPV structure. Again, on top of that as well, I do believe, if you're thinking from a form of inheritance, to set up an entity for every single property that you purchase. Now, the cons of that is, again, additional costs for every single entity. An accountant needs to manage the books of every entity separately. But when it comes down to handing down properties, or even selling on these properties to another property investor, it is much more clean. But that's my opinion. Speak to your advisors about that. It's really essential to speak to these advisors to really evaluate those options as well, so those pros and cons and those ownership structures. So hopefully, by seeing this video and speaking to your advisors, you can really make an informed decision on your specific circumstances, to see which structure really helps you not only optimize your financial benefits, so your profitability, your income, but also your potential exit strategy, whether that exit strategy is to buy and hold and then hand down, or buy, hold, and then sell. So again, remember that these decisions are, a personal decision, and you really need to see which ones really impact your profitability, your tax liabilities, and overall your investment strategy. So I hope this video itself was informative. It helped you, or at least, switched on that bulb in your head of, okay, I've been thinking about adding to my portfolio. Let me continue down this route of doing things in my personal name, or actually let me look at setting up an entity. Or if you do have properties in your own name, maybe it's time to really reconsider transferring that portfolio over to SPVs. So if you need any help regarding this, we do have a team that specializes in this. So feel free to contact us in the link below so we can have a conversation with you and see how best to assist you with this transition. Or if you're looking to purchase properties for investment purposes, feel free again to click the link below, book a call with us, and we'll see what we can do there. Hopefully this was helpful.